Okay, so joining me today are Chris Justum and Howard Hardy-King, two of the senior relationship managers at 7IM. In terms of setting the stage of what it is that we're trying to do, we try to manage your money to achieve an expected level of investment return over the medium to longer term, defined as 5 years plus. We manage various levels of risk, and we diversify the portfolios in order to minimize how much they jump up and down in value. So if you look at this little slide, the orange line going across the middle of the page is an expected return for a balanced portfolio, which is about 6%. And the red line down the bottom and the yellow line at the top are the range of movement up and down that you might expect in any one given year. And if you look at the next slide, you can see how it is that 7IM has actually fared against that in the real world over the last 10, 12 years or so. And the gray lines are the actual returns of the funds, which include the costs. So the orange line was an academic exercise, which says what should we be able to do in a vacuum without considering cost, but the gray lines are the real world. If you then look at from discrete years and you take it to longer term, 5, 10 years, you can see that what happens is that the red line and the yellow line, which are the range of probable outcomes, for compounded returns over time, converge around the expected return. So what that really means is that the passage of time itself is something that mitigates risk. And that's why we have a medium to longer term program. And you can see that, again, at the end of the 10 or 12 years that we have here in the slide, 7IM doing pretty much what it says on the tin, and that's just fine with us. We're not trying to do more than that. We're trying to do that with an increasing level of certainty for you. So that's our introduction to what it is that 7IM is trying to do, particularly for those of you who haven't been with us before. Now, the last time we spoke was just after Brexit. Chris, refresh our memories.
Well, unexpected outcomes defines it really, really well. It was the order of the day. The vote itself was for many the biggest surprise, and as a catalyst then for the changing political landscape in the UK, as well as the fact that investment markets didn't behave as many predicted. So unexpected outcomes very much defines it perfectly.
Well, we certainly did have unexpected outcomes, but where does that leave us now?
Well, that's the million-dollar question, and the short answer is, where the referendum is concerned, is we still don't quite know where we stand. I've used a quote here, Brexit means Brexit, and that's borrowed directly from Theresa May in July, and it sums up the situation really well. Theresa May has reconfirmed that she intends to deliver an exit from the European Union, but will that be a hard or a soft exit, for example?
So when you say hard or soft exit, what do you mean?
A soft exit would be, as an example, to remain part of the single market, have access to things like passporting, which allows city firms to go and do business in the rest of Europe, and have access to, if you're making cars, for example, the broader European Union. But a hard exit would be, if you like, the David Davis approach, which is let's leave first and worry about all that kind of stuff later.
So the unknown at this point is whether a soft exit is actually possible in the eyes of the Europeans, even though it might be desirable in the eyes of the people in the UK.
Indeed. And we don't yet know, as a result of whether or not it's going to be hard or soft, whether or not we're actually going to see a huge impact on the economic environment in the UK in the short term as a result.
Right, so what is this telling me?
What we do know, we've talked a lot about things we don't know, is that analysts were very negative about the impact of Brexit. And what we can see in this graph here is the City Economic Surprise Index, great name, and what it does is reflect whether or not the results that come out from a data release point of view, so in English, things like manufacturing numbers, what's going on with retail sales, what's going on with services, whether or not they beat analyst predictions or not. And what we can see in this line, which rises very steeply, is the fact that a lot of the data points that have come out have beaten expectations. So I suppose in short what that shows is both that the data that's come out hasn't been too bad, but also the fact it significantly outperformed those expectations, which were really poor.
Right, so that's what the expectations were versus the economic data. Howard, what happened to markets?
Markets were buoyant across the summer. As Chris said, the surprises in the UK weren't just in the UK. We also saw within the US data points surprising to the up as well. And as a result, equity markets, as we can see here, ranging from the US up 5.9% through to emerging markets up 13.4%, there was very strong returns to be had across the world. As sterling investors, you can add roughly another 8% to that because of the devaluation of the pound versus those varying currencies. And our portfolio benefited from this. Our balanced portfolio, for example, which only has roughly just below half exposed to these kind of equity markets, was up 8% over the summer.
Well, markets gave us a nice surprise, and we were on the right side of that, as well as being on the right side of the currency picture. And now we're seemingly in a bit of a transition from focusing on markets to looking again at what our good friends, the central bank, has been up to, Howard.
Yeah, central bankers have really been the focus of markets for, well, a good few years now. What the policies are, where easing's coming, and really the three bankers that you see here, from Carney to Draghi to Yellen, the impact that they have on markets and where they see rates going is really driving things. And you can see on the next chart what's been going on in Japan, the Eurozone, and also in the US. So the red line here, which is gradually increasing to the right, shows the added stimulus that the Japanese bank have been adding to the markets over there to stimulate growth and inflation in the marketplace. The same in Eurozone. However, the US is a slightly different picture, and since 2014, we've seen stagnation there. The key question is, where are we going from here?
So Howard, I take that as a very, very important little piece of information there. It tells me that the US is traveling a different path than at least Europe and Japan. So in the US, quantitative easing looks to be at the beginning of the end stage. And in fact, as you'll hear in a couple of moments, they're actually toying with the idea of raising rates right now.
Yeah.
Japan has been unsuccessful so far in being able to stimulate any inflation, and so they're pushing the boundaries yet again with the central bank. Europe, you can say the same, but we haven't actually seen the inflation come through. Although you can argue that they probably staved off a really, really messy time back in 2008. So where are we right now, Chris, in terms of the US and the central banks?
Well, you quite rightly mentioned the US is trying to get on that path back towards normality. So in that yellow line that we've just seen on the chart, we've seen quantitative easing started to plateau there, and path back to normality as well as that does mean rate rises. Every single month there is an interest rate decision. The Federal Reserve Open Market Committee sits down and lets us all know whether or not they're going to raise rates, reduce rates, or keep them as they are. Running up to that point, there's an awful lot of speculation. And what this chart here shows quite nicely is that the blue line is the probability of a rate hike in December. The black dotted line shows the probability of a rate hike in December. So as I said, every single month. And in blue there, what we can see is the interest rate decision last week, which was, no, we're not going to raise rates now, but it is still on the table. It's all about the rhetoric they use. People are pouring through thesauruses after we always get these minutes that come out. And we can see that reduced all the way down to 0. However, the black dotted line shows that an interest rate hike is still on the table for December, about a 50% probability.
That's really important, because now what we're looking at is rate rises possibly in the US, and if not in the rest of the world, the potential implications that that might have for the dollar. So if rates are higher in the dollar and it attracts money, we've seen that that can cause some turmoil in markets before. The other thing that we are looking very closely at is central bankers arguably are running out of room. They're running out of ammunition. They don't have any more bullets in the chamber, whatever metaphor you want to use. And what that does is it puts an increasing emphasis on fiscal policy, spending and investment decisions by governments, which takes us to the political world. And in the political world, we have some very, very topical events right in front of us. Chris.
That's right. Well, politics is usually a consideration or a factor when you're looking at investment in, I suppose, some of the less developed areas of the world, or maybe less stable in inverted commas. Brazil's a great example of that, where we've seen scandal, impeachment, and what have you, and the effect that's then had on the economy and the investment markets as a result. But actually, this has changed in some of the more developed areas, and we've got the two pictures here. So things like Europe and the US. We've seen the potential impact this is going to have going forward and some of the uncertainty that's arising as a result there. I think this reflects quite nicely as well just how close things have been, and about how in a matter of weeks we can see between the 14th of August there and the 19th of September how quickly things can change. And this just reflects the polling margins rather in some of those swing states which have a big impact on who wins a general election and how much they've changed between Hillary Clinton and Donald Trump.
And the relevance of this to us in our portfolios, of course, is we need to understand what those fiscal policies will be, particularly if we're in a world where central bankers are running out of bullets. Massive change in a very short space of time. And indeed, last night, of course, we had the first debate over there, and early results we're seeing are that Hillary may have done fairly well in the first debate.
And what quite a lot of people are looking at are things like this, which just reflects overarching. So we've seen a breakdown of what's been going on in each of the states, and this shows where the poll sat as of yesterday before that debate. What we can see is since April how much this has diverged. So it's gone from a case of Hillary Clinton was a significant favourite and Donald Trump didn't seem as close, whereas now it really is neck and neck.
So we not only have political uncertainty in the US, but Howard, we've also got political uncertainty in Europe.
Very much so. Over the next year or so, we have got a range of different referendums and elections that are going to be happening across the Eurozone, which actually impact around 90% of Eurozone GDP. So what that means is political uncertainty in Europe, political uncertainty in the US. Markets don't like uncertainty. So the key is, where are they going to be heading from here?
Okay, so we've had buoyant markets helped by very generous central bankers. We're now looking at the need for fiscal policy with uncertainty as to whether or not that can be delivered. How about the world underneath? How is that looking, Howard?
Well, global growth has actually looked remarkably solid. It's not really breaking away. However, we forecasted coming out of 2008 that it was being out of the credit crunch, and that is very much what's happened. There have been areas around the world that there are more concerns around growth than others. However, global growth has remained solid, and we don't see any immediate threat to that.
So Howard, these are nominal growth numbers?
Yes, they are nominal growth.
So one of the things that we need to remind ourselves of when we look at numbers like 3% growth is if inflation is close to zero, there is real growth in the world. So that the underlying world, probably despite the politicians, seems to be doing relatively okay. Not gangbusters, but relatively okay. So if the economies are doing okay, what are markets looking like?
Well, markets have reflected the point about growth that you just mentioned. And what we can see here, each one of these lines just reflects and corresponds with a different geographic area. So we can see in Orange, for example, we've got America at the top, and we've got the bottom, emerging market, Asia. And what we can see is valuations, so I suppose in English, the price of a company and what it's worth, have continued to tick up.
So the question that we have as a fund manager is, for a world where we have sort of okay growth, are equity valuations getting to a point where they're looking a little bit expensive, particularly if you factor in the near-term political uncertainty?
That's right, and I think what we should probably mention as well is just have a quick spotlight on the emerging markets, because we like to talk about these a lot, and the newspapers do as well when things are going badly. What we can see though, the Purchasing Managers Index, for those who aren't aware, because it's a horrible investment term, it reflects ultimately sentiment within a specific area. So we've got three lines here. One of them is for the manufacturing in the emerging markets, one of them is for the service industry, and one of them, which is the darker colour, reflects a composite of the two. And the purchasing managers are ultimately the people who hold the purse strings. So if these people are going out and spending money, ultimately it means there is expansion, and we see a number above 50. Any number below 50, when we're looking at that, I suppose that poll that goes out, we see contraction. And what we can see is a clear uptick more recently, so confidence in that area and sentiment is picking up.
So we have an interesting position from a global perspective here, in that emerging markets, and in particular Asian emerging markets, are in some ways looking more stable than the developed world. They're certainly looking more stable politically at the moment, which is very unusual. We may never say that again in our careers. But even from an economic standpoint, the non-commodity driven part of emerging markets, which will roughly say is Asia, if we can overstate it, or simplify it rather, looking relatively buoyant versus the rest of the world. So given the situation with what's happened in markets, our view of central bankers, our view of politics, our view of valuations, what do we do? Chris, what have we been doing?
Well, I suppose as a quick recap for those who aren't aware, we talk a lot about structure and process at 7IM, and part of that, a big part of that, is a formal quarterly meeting where the investment team will sit down and look at, I suppose, the next 6 to 12 months, what's going on in the world, and how do we want to position the portfolios accordingly. And I think what this reflects actually is that in between those quarterly meetings, from time to time, we do have to make changes in the interim. You can see the different dates on the left-hand sides there, where we've been actually very active in the last couple of months, which I think Howard will break down in further detail.
Yeah, so this chart here just simplifies what we've actually been doing over the last 3 months. And as Tom referred to, with what's going on with growth, what's going on with politics and the uncertainty around that, we have taken that opportunity to take profits from various different areas around the world and reduce the risk within the portfolios. So we've bought insurance within the alternative sector against the US equities. We've reduced our Japanese and European holdings and taken profits from Asia. The bond market, we've also seen a rally. We talked about equities earlier, but across the summer, gilts and other government bonds also rallied, so we've taken profits from those too. Within currencies, we saw a big move coming out of the referendum in terms of sterling. We need to be mindful, though, that these can go the other way as well. So we're managing currencies as well within the portfolio, and that's been something we've been changing across that 3-month period.
Okay, so for those of you who were not familiar with what our positions were 3 months ago, we had probably our largest ever dollar exposure going into the Brexit vote. As it turned out, that turned out to be a good place to be, but we have significantly pared that back now that we've had the dollar move, and we're back to what I would call a normal foreign currency exposure in the portfolios. So that's what we've been up to, lightening up on risk, having taken profits, and looking at near-term political uncertainty in the developed world. So what's likely to happen coming forward?
We've just concluded our latest quarterly asset allocation committee and tactical decisions. Chris and the team are in the process of implementing that within the portfolios at the moment, and this gives a high-level summary of some of the moves that they are looking to do within the portfolio. So again, the theme is reducing risk, allocating more money to cash, looking for opportunities, and moving our money within the bond space to look for valuation opportunities there.
Okay, so if I can just inject here, one of the challenges that a fund manager has these days is what to do about fixed interest. Fixed interest rates are at all-time lows, which means prices are at all-time highs. So if you look at a graph of gilt yields over the course of 200 years, they're at their lowest that they've ever been right now. And that is somewhat as a result of the quantitative easing programs that have implemented by the major Western governments. If we are concerned that at some point in time that's going to turn around, and we are concerned about that, we have to devote a fair bit of our time and effort to that alternative space. What can we invest in that doesn't behave like equities and won't give you the exposure to long-term gilts that will provide the balance in the portfolios so that they don't get volatile in a period of time where equities might get a little bumpy. So that is where a lot of our energies are focused at the moment. And Howard, you
can see here by this chart the position that we had back in June, where we had 46% in equities. We've reduced that significantly, and that has really bolstered the cash position. That cash is looking to be deployed into those areas that Tom referred to in terms of alternatives. However, we are mindful of valuations, we are mindful of where those opportunities lie and when to deploy them. So small things like increasing our gold exposure, the US insurance that we bought within the portfolio has gone into the alternative sector as well.
Right. So really what we're saying is, as we have a little lack of vision as to what's happening on the political front right now, we're putting extra cash in the portfolios until we can see a little bit more clearly what the fiscal policies are that we'll be looking at, and then we'll have an idea of how it is that we want to redeploy that cash. And we just think that's kind of a sensible way to manage your money, particularly having had a very good run in the portfolios. Let's take some profits. So that's kind of where we are. We continue to manage the money to expected returns. We would like at this point in time to see if there's any questions from the audience.
Thank you, Tom. We've had a couple of questions in, but just a reminder, if you wanted to ask questions, it's to use the grey box on the side, open up the questions sector, type your question in and press send. So the first question we've had, what do we think a Trump versus Clinton victory will do to markets?
Yeah, that's probably the one most people would be asking right now. Not only do we have uncertainty as to who's going to win, but then we have uncertainty as to what that would mean for markets. In the case of Brexit, it was crystal clear. If we had Brexit, the pound was going to suffer. So our major question there was, will we or won't we have a Brexit vote? Here, it's a little more nuanced than that. Not only do we need to know who is going to win the White House, but we need to also know who's going to win the House of Reps and the Senate. Because if one party has control of all three branches of government in the United States, they will be able to do things. And the policies of the individual will come more and more to the fore in an environment where the three houses are controlled by one party. If we have a split government where we have Congress is not of the same party as the White House, it'll be harder to get things done. We frankly would favor the latter. We're okay with the system of checks and balances in the states. We think that the U.S. seems to be in electoral mode, edging toward protectionism, and we're not sure that that's a great thing for world trade. And some of the populist statements that people make when they're trying to get elected sometimes turn around into more centrist policies once they get into office. We certainly take that view with Hillary, and with Trump, it's a real unknown. So if we get Hillary, and if Hillary doesn't have a Democratic Congress, then that would probably be our happiest position from a portfolio management position. That's not a political statement, that's a portfolio management statement. If we get Hillary plus a Democratic Congress, then we're going to have to focus more clearly on what she says she's going to do on a fiscal front. And if you get Trump, it's a real wild card.
Okay. Next question we've had in, Tom. My understanding is that you are hedging for a possible large fall following the unexpected market rises following Brexit. Can you explain what you are doing in more detail?
Right. So we're not looking for a large or a sudden fall. We're looking for a drift in markets. What we saw in the wake of Brexit was an unanticipated rise in equity markets in particular, and that was because the early data didn't seem to indicate that Brexit was going to be a problem for the world. However, upon reflection, if Brexit becomes a problem for the UK and outside the UK, it's not going to manifest itself for a couple of years yet. And I think the market's now coming to grips with the fact that we don't even know what Brexit is yet. They haven't even triggered Article 50 yet, and there's another 2 years to go after that. So the danger is that the impact of Brexit is 1.5, 2 years, 3 years out on the horizon. And if the market starts to get its head around that, we could see a little bit of a drift. We are not looking for a precipitous fall in markets. The danger that we see in markets is one political, and the other danger that we could see in markets is the fixed income markets if there's a sudden rise in rates. We think that the inflationary pressures are so weak at the moment that a sustained rise in rates is very unlikely. So what we're really doing is taking profits, looking at a bit of uncertainty, which markets don't like, not looking for a precipitous fall, but looking where to redeploy the cash as and when we understand what the political outcomes are.
Okay. How do you see inflation prospects over the next few years?
We continue to see inflation as low. There is an oversupply of goods and services in the world, and for that we can probably thank globalization. And we can also thank the demographics. So as the baby boomers move through time, they've sort of changed every market that they've gone into. And so what we're doing now is we're seeing that the baby boomers are moving into retirement, and as they move into retirement, the consumption drops. And with low interest rates, we've had lots and lots of lending available, so people can borrow cheaply to produce goods and services. And until we redress the balance of goods and services in line with demand, we think we're likely to continue to see low inflation. That's going to take a while to work through, so that we're not looking at rapid rises in inflation.
Okay, I see that you have much less foreign currency exposure than you did 3 months ago. Why?
Yeah, I think we referred to that a little bit earlier in the presentation. We had our very large dollar position, large for us, which was probably about a third of the portfolios, pre-Brexit, as an insurance policy. So managing tail risk. Remember, when we went into the Brexit vote that day, the world didn't think Brexit was going to happen. And we had the dollars there just in case it did happen, because the markets had already moved up in anticipation of a Remain vote, and we thought that if we got the Remain vote, then we might get a little bit of a move, but if we got a Brexit vote, we get a very adverse move, which indeed we wound up getting. So we've taken that extraordinary circumstance to have the dollar position. It happened. We've now normalized our position, and so I would say where we are in currencies right now is back to sort of a neutral position.
Okay. And the final question, is it time to take tax-free profits in view of the uncertainties of the next 12 to 18 months described in the presentation?
Well, again, we're a medium to long-term investment program. We don't encourage people to think short-term. I would always encourage people to harvest their capital gains taxes and possibly reinvest the money in something else on a yearly basis. If the government gives you a freebie, and capital gains tax allowances are a freebie, then you should take the freebies. But would I take it as a panic move? No, I would say not. So, do we have any other questions, Michael?
No, that's it, Tom.
Okay. Well, thank you all for joining in today. I hope that was informative. I hope it gives you an idea of how we run money, what we're thinking right now, what we're doing about it. And can I encourage you to please talk to your relationship manager, Chris, Howard, or any of the other relationship managers at 7IM, if you'd like them to elaborate on anything that we've talked about, or in fact you'd like anything done within your portfolios yourselves. So thank you very much, and we'll probably see you in about 3 months' time. Take care now. Bye-bye.